Hello and welcome back to Equity, TechCrunch's venture capital focused podcast where we unpack the numbers behind the headlines. My name is Alex Wilhelm and I'm joined by two of my absolute favorites. I've got Natasha Mascarenas here. Natasha, how are you doing?
Doing good. We were talking about pumpkin spice lattes before this, so I now know what I'm doing after we're done recording.
And that's also why I'm glad we don't record the entire pre-show and put it on the internet. Danny Crichton's also here. Danny, how are you doing, my man?
I'm doing all right. I recently found out that there's such a thing as a puppuccino at Starbucks, and I've decided that is the new low standard after the pumpkin spice latte.
I mean, to be clear, I've never had a puppuccino, but I don't think it would be very good.
It's literally, I think, a cup of whipped cream. So actually, it is for us.
I mean, that sounds like the best drink at Starbucks now. Maybe we should all just get those.
And it's free, apparently, with the order of another beverage.
All right. Well, now that we've gone over how to get diabetes, an outline for the show for everybody. We're going to do this now at the top of the show, give kind of a rough look at where we're going so you can kind of track as we go. We're kicking off with a couple of notes about media, some startup rounds, some big news. Then we're going into housing, a couple of really interesting venture capital rounds there. We have a really cool accelerator before we wrap. And at the very end of the show, something fun that should make you laugh. So,
well, I mean, talking about Tiger King and, the pandemic, Netflix reported earnings this week, and it was actually a little bit surprising. So, I mean, it's like the best and worst times to be a video streaming. So in Q2, Netflix reported 6.8 million new subscribers. Earnings went up massively. Everyone's streaming, everyone's watching television. And then Q3 happened, right? And obviously Netflix, I think, accelerated a lot of its growth early. And so this quarter was a little bit more disappointing, only gaining 2.2 against analyst estimates of 2.5. I believe, Alex, the stock did not do well in aftermarket trading. Is that correct?
It did not. It dropped about 5-6 points last time I checked. But I mean, the $2.5 million number is actually from Netflix. So they missed their own estimate, as well as the street, which I think was slightly higher. So it's kind of a really sad quarter. The question is, what happens in Q4? Can they bounce back? Can they find more demand? How saturated are their kind of home markets? I don't know anyone who doesn't have Netflix. Maybe that makes me weird, but I don't know how many more people they're going to sell to in the US. It's got to be pretty much hollowed out. So I wonder if Netflix is going to have to go more international and if that'll shift dollars to, content that I might not be as interested in.
Well, I think international is everything they're doing. As our reporter Manish Singh in India was talking about this week, Netflix is actually considering, or maybe is now official, giving free access for, I believe, a weekend? Where it's like all you can eat for 2-3 days. It's going to be like a big, countrywide thing. And the goal here, of course, is to acquire all those users super cheaply. So to build on top of WhatsApp and other chatting apps to make it a big spectacle, in much the way that Fortnite has done this with some of its concerts and some other video streaming services have done this. AOC was on Twitch or whatever, Among Us this week with hundreds of thousands of streams. So
that was a surprise, Danny. That was a surprise for the end of the show. That was the treat that I mentioned earlier. You've now ruined the treat.
I couldn't get there. I merged it all in. Move forward. But I do. Obviously Netflix's international growth is key. That's what most analysts are looking for today. But that's a saturated market too. Netflix is buying more content libraries internationally. We've seen this with telenovelas. We've seen this with K-dramas. We've seen this with Bollywood. But it's early. I mean, it's an American company with an American content library, and it's still kind of in this mid-pivot of trying to get more international customers.
Totally. Yeah, Danny, I was just going to go off a little bit of the kind of weekend palooza we might start seeing from Netflix, because in replacement of, or because they're going to start doing that, they're going to be taking away the 30-day free trial, which I think is not being talked about enough. Like, that's pretty wild. They no longer are going to have free trials. What?
So sorry, help me out here. So in India, or is it globally, they're doing this?
I believe it is being rolled out like localized first. So first India, and then it's going to be part of their broader strategy, which maybe is like the innovation we've needed from Netflix to bring on new users.
to make the onboarding process worse.
I put this in the Apple removing the power adapters from iPhones category of,
right.
It assumes that everyone knows exactly what your product is. If you're let's say you just got your first iPhone, that's going to suck.
Yes, because you're going to go and plug it into USB-C.
You play it for 8 hours, you're watching Netflix, and then all of a sudden you're like, oh, I need to plug this in. Damn it. What happened? I support the move to remove power adapters. It's green, it's good. But I do think the same thing is true with Netflix. I mean, who at this point really doesn't know what Netflix is, at least in the US? I do think in these other markets, the opportunity here is also to work with groups like Reliance to actually get better distribution, right? In many parts of the world, bandwidth is very, very expensive. And so my imagine is that Netflix will continually partner with local telcos and other providers in order to kind of subsidize that bandwidth in these sorts of free trial periods.
Shifting gears a little bit, I know another company that did, much better than Netflix this week. Alex, do you want to take us through kind of Snap's earnings?
Yeah, so I'll be quick about this. Snap had a really good quarter that was also bad. So compared to expectations, it was much better than anticipated. The company posted 52% year-over-year revenue growth to $679 million, a legitimate explosion of growth compared to its Q2 growth of 17%, and even better than its Q1 growth of 44%. Investors love this. Shares went up. Big huzzas for the whole Snap team. On the other side, it still lost $200 million in the quarter. It still burned through $55 million in cash just from its operating expenses, and paid out $192 million in share-based compensation during the quarter. So it's one of those Rorschach tests of a quarter. You can either look at the good stuff and be like, gross margins are improving, less cash burn, or you can look at the other side and go, still terribly unprofitable, miles away from GAAP net income, and kind of a mess. But it appears that just like TikTok, Snap is finding a way to excel even in this Facebook world, even in this platform world, and hold on to a material audience and even grow at 18% year over year to 249 million DAUs in the last quarter. So I'm impressed.
Do any of us use Snapchat?
I do, but that's also predictable that I do.
The Gen Zer does. Okay. So I think this is one of those stories that Snap just doesn't break into the conversation, at least my conversations, right? I don't see it in the business press. It's too small. It gets overshadowed by Facebook. It certainly gets overshadowed by TikTok these days. But to some way, it's like the little engine that could. I mean, it is actually growing. It's actually held on. To believe it or not, years ago, people were shocked that they didn't sell for $3 billion to Facebook. And now it's a real company, and even though it's still losing money, it is sort of narrowing those losses over time. So in some ways, it's been a slower story than Facebook. Facebook went through this kind of wilderness period of trying to figure out if it could ever be profitable. But Snap seems to be on that course. I mean, do we know when they're going to kind of flip the bit and go into profitability, Alex?
I mean, they've talked about it in the past. So if you go back a year or two, they were talking about kind of this big boom to go towards profitability. What they did do was take on a lot of debt, and then that gave them lots more runway. So Snap is actually very well capitalized. They have, years and years of runway. I don't know if they have years and years of investor patience on the profitability side, but certainly they have a lot of space to go. I mean, that's why they paid, I think it was like $28 million in interest costs in the quarter, because they have this enormous debt load. But I think they're going to need to reduce their share-based compensation to stop diluting their existing shareholder base. And that could push up their cash comp requirements and make the whole thing a little bit harder to balance. But you know what? Investors loved this. And so it buys them a couple of quarters of space. Evan Spiegel is still in charge. And you know what? Charging off in his own direction, doing his own thing, not becoming Facebook, and succeeding in a way that I didn't expect. So sure, there's issues with the numbers, Danny, but on the whole, gotta give it to him. I guess I sound like a Snap bull for the first time in my life, but I was no, this is legitimately, the growth number this quarter was legitimately good. I can't take anything away from it. Props and well done.
I want to also give a nod to Snapchat's focus on kind of creating a more developer-friendly and accessible platform. We saw Hags, which I think we've talked about a couple times on this podcast.
Have a great summer.
Good job, Danny.
Not having awesome greatness, whatever I came up with in the quiz show we had, the very, very comprehensive quiz show that I'm sure followed game show laws.
Well, Hags was an example of a company that was kind of built atop Snapchat as like a virtual yearbook. I think Snapchat is cooler than we realize a lot of the time. And I think we'll see a lot more apps and Gen Z creators building stuff on top of it. That's something TikTok doesn't have. You can't build on top of TikTok yet, but you can build on top of Snapchat. It's also video. That's more interesting to me.
I will say combining Snapchat with yearbooks actually makes a ton of sense to me. I think there's a ton of people who would like everything from their yearbook to disappear.
Oh, Danny with the long wind up to the joke. I think Snapchat is cool because we don't know about it, and that's why the kids like it, because Danny and I aren't showing up there with our old man selves. I was going to say,
I think Natasha's actually implying that we're not cool. Isn't that what that was like the implication in the bottom? She's like, it's where cool kids are, and we just talked about how we don't have it installed.
She wasn't implying, she was directly stating that you and I are not cool. And to be clear, I'm not offended by that. I made peace with that when I was 26.
Alex, that's because you and I read books.
Oh,
Book
I
oh,
read
readers
books.
are never cool.
Natasha and I have been in a book club together. So like,
The
listen,
book club, the actual startup that we were talking about, or like a real book club?
a real
Like book club without a space?
Get you a journalist that can do you both.
Yeah.
Do both Snapchat and book
How
clubs.
about that, Danny?
There you go.
You have
We
more
can be
board
the
games
next-
than books, Danny. You can't talk any smack whatsoever. Now, listen, we're going to go from the media macro, and we're going to go talk about a couple of smaller rounds in the media space, kicking off with one that I'm kind of excited about called Stir. Natasha, what is up here?
So Stir raised a 4 million seed round. It helps creators and journalists who are already collaborating on a ton of projects kind of share the revenue that those projects can eventually bring in. My first thought on that is it makes a lot of sense, probably formalizing something that is long happening. So not a super innovative concept, but one that does need attention. And we also obviously are seeing more and more creators go solo. And so if you can somehow help them incentivize the idea of working with other people and kind of spreading that risk a little bit, that's exciting to me.
Yeah, I really like it. I got to say, it's not a huge amount of money, but certainly an interesting space. We saw Homebrew and Ludlow along with XYZ Capital in the round. And you know what? I mean, we talk a lot about like how platforms like Substack let individual writers go out there and do their thing. They're pretty rigid. And now Stir doesn't work with Substack yet. It works with YouTube, Patreon, Twitch, and Shopify, and we'll add some more stuff down the road. But like if someone told me that I could start like a subscription newsletter, collab with friends, and share the money intelligently without having to get super wild about Venmoing each other, that'd be super attractive. I think it would make it easier for folks to go out indie and also to pair up in 2s and 3s. And that's why I'm in favor of this, Danny. I don't know how big it's going to get or how big the TAM is, but certainly it's a fun way to look at the future of creation.
I agree 100%. I mean, look, we've seen a ton of collaborations on YouTube, for instance, and it's always this awkward, piece at the end that are like, subscribe to my channel. And like, but my channel is the only one you can subscribe to on this page unless you click on the link, and it's very complicated.
Yeah.
So I actually think creating better mechanisms, it's basically empowering new business models here. Now, the question is, of course, will those business models be used? Is there enough of like just a flow in this kind of payments category? I'm really skeptical, quite frankly, but that's the beauty of Seed. It's a huge bet. I think it's very empowering. In the worst case scenario, it's an acquisition to one of these companies. The best case scenario, it's a really interesting play. So I actually liked it a lot. As we talked about, it was Homebrew, Ludlow Capital, and XYZ.
Another example of a startup we're seeing kind of pop up to help support indie creators is Quake. Danny, tell us about Quake.
Yeah, so subscription podcasts, not a thing, but they want to make it a thing. And so it raised $2.5 million in seed to create basically a network of podcast hosts who will pay, you can pay, I guess, $5 a month or $50 a year to hear from stalwarts like Laura Ingraham, Soledad O'Brien, Gretchen Carlson, Mike Huckabee, Andrew Gillum, Mark Lamont Hill, and Buck Sexton, which is an interesting agglomeration of folks who probably shouldn't be in a room together.
No.
But they want to fall in the line of Luminary. This is a really tricky space, right? Because there's so much free content. Everything's available everywhere all the time. In fact, one of the beauties of podcasts is that they're mostly driven by RSS feeds. So you can use Apple Podcasts, you can use Overcast, you can use Spotify, you can use everything. And it's not that exclusive outside of a couple of shows like Joe Rogan, which have been bought out, by Spotify earlier this year. So I think it's interesting. I do think there's a potential in politics, much in the way that The Athletic has done sports. It's one of those categories that tends to get people really, really engaged. They've described it as the next generation of satellite radio. I could see that particular category doing well. Obviously, I don't think it's going to expand outside of that.
But what we've heard from the Luminary experiment, they raised about $100 million. They were going to go out there and do the same thing. Lots of kind of like hosts that were going to be unique to the platform. And it didn't go that well early on. Now, things could have gotten better at Luminary. I don't want to be super negative about it, but the first stats we saw out of the experiment weren't particularly great, and it had a very high burn rate. And I'm just not sure if the paid podcast world actually works here in America. Natasha, we know that in China, the podcast market is a huge space. People pay for shows there. It's just a different cultural norm. Do you think that with 2.5 million and Laura Ingraham, Quake has a shot?
So, I mean, people pay to fall asleep to Matthew McConaughey. I think people are crazier than we think when it comes
you say
to
people, do you mean a certain person in New Jersey?
Not me.
Why
Never.
would you fall
Me?
asleep to Matthew McConaughey?
No, well, that's Calm's whole thing, right? No, it's one of their offerings. But
I
no,
see.
jokes aside, I think like they're
We're offering you Matthew McConaughey.
and
How about
that
a Sean
is all.
Connery at night?
I don't want this to get into a weird conversation, so I'm going to answer your question more directly, Alex. I think
just
in the
avoid Danny.
I think in the States, I think what Danny said is right. Politics has a fanatic aspect of it that people will pay for. So maybe that will be its success. But I think that overall, the way that we view education in the States is not something that we pay for. China with families all across the income level, families pay for their kids, for education. I think one of the highest paid podcasts in China is a teacher talking about college entrance exams.
Wow.
Some data we have is that the paid podcast market in China is worth $7 billion. And I think that I wouldn't say that Quake is like, ahead of the curve or the future. This has been tried and failed. And I think we just need to remember, it requires much more than Laura to get us to rapidly adopt it. It requires all of us to think differently about how we pay for education.
Yeah. I'm optimistic though about that because they only raised $2.5 million. They can't get too far over their skis. They can't build a cost structure that's going to be absolutely insane. Luminary felt in microcosm a bit like Quibi, raise a bunch of money, build out a stable of stuff, go out there, launch it, and then hope everyone signs up for it. With $2.5 million, they're going to have to keep it pretty small, and maybe that will succeed. And as always with media things, my bias is let it work because I would like to keep doing this for a while. So, Danny, sorry.
I'll make a note. Meg Whitman, who was the CEO of Quibi, once said in an interview that she was targeting $100,000 per minute of a Quibi video in terms of production values. I think one of the things we don't talk enough about is like how much does it cost to create good content? Podcasts are still in this nice world where it's like, look, if you have high quality equipment, it's actually a capital cost. It's not an operational cost. You can actually produce amazing work quite cheaply. That's one of the magics of podcasts. So, I agree with you, Alex. I actually think, Luminary I think they described themselves as the HBO of podcasting. They wanted these great stories, really in depth, lots of production values. I'm not sure listeners are able to actually see that. And that's part of the challenge when you're sort of building these business models.
It'd be fun to do one week would be to actually put the show out without Chris making it sound good. Because I think people wouldn't understand how much he improved the show. And that's where the production advice comes in the audio world. But we can do it with a team of 4. We can do the show with 4 of us. And a video requires 40. So there is a diminished cost. But certainly I don't want to knock how much work goes into making the show actually operate a couple of times a week.
No, I mean, look, the Committee on Presidential Debates / Chris Gates, has to give me a mute button because he cuts at least 25 minutes of my content out at every episode.
That saves your job.
Oh my God.
Let's get into some more funny rounds here really quickly. Let's talk about, Danny, is this pronounced Abodu, I think?
So we're going to go into a housing section. So there's a couple of different housing startups that came out this week. Housing is obviously on fire. Housing sales are up. People are moving. The migration rate in the United States has declined every decade since the 1970s. It is zoomed up as people are escaping the major cities, kind of reconfiguring their lives for coronavirus. And so Abodu is one example of this, raising, I believe, $3.5 million, led by Initialized Capital from our former colleague, Kim Mai Cutler, who was famous for talking about vomiting anarchists on a housing essay multiple years ago. And what she was investing in with this company is the future of what are known as accessory dwelling units, or ADUs. And so if you have a classic single family property lot, in most states you have some sort of capability to add sort of an accessory unit, basically a detached shelter. It's usually a bedroom. It might be 1 or 2 rooms onto the property, generally within the zoning codes. And, they're sometimes known as in-law units or ex-law units or whatever the case may be. It sort of depends on your family dynamics. But Abodu wants to make that super cheap and easy. So for around $200,000, depending on the unit, plus some accoutrements if you want more premium features, they will basically construct in a factory an accessory dwelling unit, put it onto a semi-truck, drive it over to your house, use a crane to move it literally over your house into your backyard, wherever the siting is, and install it. And the beauty of it is it takes about 14 weeks with permitting. They're actually able to get the permits in San Jose now in less than an hour. Other cities are a little bit longer. But what's interesting is that they don't need a lot of time in your backyard. This is sort of the magic that they're sort of focused on. They need about 2 weeks from start to finish. So they prep the site and then they just put the house in. And in almost no time, you basically have this unit ready to go.
So I think this is really, really cool. This reminds me a lot of the tiny house shows that I've seen a lot of during the pandemic because I've had a lot of time on my couch. People love tiny houses and they love to put them in their backyard and expand their square footage, have more room for more people. 200K seems, I don't know, expensive to some degree, but I mean, I'm sure a lot of folks can afford that. Much cheaper than buying a bigger house, I would presume. I think this is going to be hot, Danny. I would not be surprised to see it do well, though kind of a small round for something that has such large capital expenses.
Yeah, the startup was a little concerned about talking about, the costs and how much money they had raised and stuff like that. And it's really this is truly equity, right? Almost all of this is debt driven. So from a homeowner's perspective, they're using HELOCs, home equity lines of credit, or other mortgage products to buy the houses. And because it's basically built to order, they don't have the factory overhead costs. I mean, they're not building like a massive facility for tens of millions. They're not Quibi-ing it. That's going to be our verb for the next week or two. So their cost structure is actually a lot more reasonable than it looks. And what's interesting to me is in the past, ADUs have been basically investment properties. So you build this little unit on your property, you rent it out for $1,500 or whatever, $2,000 a month. It's a nice way to sort of pay the taxes, pay the mortgage, etc. What's happened post coronavirus, though, is that with kids coming home, with grandparents looking to separate and potentially socially distance from the rest of the family, there's just actually a lot more focus on the family side going on now, less than the renter side. So I think some of the controversy, obviously California's had a lot of controversy around ADUs. They passed a law earlier last year and then enforced starting this year that basically make ADUs almost mandatory, a requirement. You can basically build them at will. And that's actually been very sensitive because of the investor side. I think as more and more families use them for their own sort of members, it'll be less controversial and much more the norm in many neighborhoods.
Yeah, I mean, I'm excited for the startup. I think that the quality will be so key here. I saw the pictures in your story, Danny, and I was super impressed. If anyone needs to be cheered up, go look at Amazon tiny homes that they sell. And it's just like a perfect example of the opposite of what this company offers. Super just horrible quality. And shows that there's a huge demand.
Wait, there's
for
bad
them.
Quality on Amazon? I had
know,
no
right?
idea. That's why I always buy my caskets from Costco. Those people, Costco, where you get caskets. They didn't really want me to say that. Oh, we did have one other housing story. Yeah, we're going to get emails. Don't email us. There was one other housing round I talked about this week, $4.5 million into a company called WOHO, which stands for Whole House, but not really a whole house because it actually... Don't think about it too hard, but WOHO. And they're actually trying to rebuild modular buildings. I don't want to get into it. It's actually really complicated. But the idea is you've seen some modular apartment buildings where you can kind of just stick the apartment units into each slot and you sort of have this magical building. These are actually like Lego bricks that actually connect together with each other. And they allow people to basically build multi-floor buildings in groups, right? So you can connect these components together. It might be 2 floors for one component. And they all connect together, allowing more flexibility and great. And so the part that I love here is that we're seeing more innovation around construction, more innovation around green building materials, and more innovation around speed. Because one of the biggest challenges with most of these categories, this is actually the problem with ADUs, Alex, is that in California, the average ADU is like $350,000 to build and takes 2 to 3 years. Right? That's the market norm, 3 to 5, 2 to 3 years, because you got to get permits.
So much changes.
General contractor, you got to do property work. Being able to do it in 10 to 12 weeks, 2 weeks in your backyard, get a permit in a day, it really changes the game.
Yeah, it could really shake things up. We'll throw in just one more quick round onto the housing-ish pile of stuff, if you will. RVshare has raised over $100 million in a new round for its RV rental business. So if you were hoping to get out there in the Great American West, for example, in an RV, the companies that are now trying to rent those to you have a lot more capital. RVshare is really cool. It's actually based in Akron, Ohio, which is, I think, the first Akron company we've ever had on the show. I just like saying Akron, and I really hope that's how you pronounce it, not Akron, because then I'm going to sound really dumb.
It is Akron, as a local or one-time local.
Thank you, Danny. Bringing that Midwest vibe to the show. Thank you. The company saw a 650% increase in bookings from April to May of this year. Why? Well, because we were all stuck at home going stir frickin' crazy. So everyone went out in a, I almost said Airbnb, which is my next point, in an RV. And so obviously a lot of demand, more capital, lets them get more vehicles out there on the road, more revenue, huzzah. My read, guys, is that this is just the Airbnb story again, but with wheels. Airbnb used to do international, now they do local. This is the same kind of concept.
I'm actually like less bullish on RV companies than I was when we first talked about them maybe like 2 or 3 months ago. And like a lot of the like I need to get out of my apartment conversations were happening. I think like I'm much more bullish on like local trips and stably staying somewhere. Stably is not a word. Being stable and staying somewhere. I think
Why?
RVs I think RVs were like definitely like an example of how traveling looks in a pandemic, but I just don't see that kind of mass adoption as much as we'll see people just wanting to stay put somewhere. I don't know.
Well, I mean, there's a lot of bets, so we'll find out really soon. Just to wrap this up, Outdoorsy, which is peer-to-peer RV rentals, has raised, I think it was an $88 million round somewhat recently, or $88 million in total. Cabana, which is doing kind of like RVs/hotels, raise money. And then there's Kibo, which is also out there kind of doing van stuff. So a lot of money going into this, a lot of bets. So we'll see who is right, Natasha and the stay-at-home crew, or the RV crew and the get out there and crash crew.
Talking about stay at home. Natasha, you had a piece this week talking about hackers who, went from digital nomads to being in San Francisco to being digital nomads. And now I guess they're going back to the stay at home model of hacker houses, which tell me about the Pineapple Palace and other hacker houses that are out there.
Yeah, we're seeing kind of the conversation on work from anywhere turn into founder homes and collectives. There's a couple type of houses that kind of fall into the bracket of hacker homes, which, yes, do not email me. I know they're not new, but they are new given the fact that we can choose to work from anywhere now, and we are choosing to live with people who are exactly like us. So there's the Pineapple Palace, which is a house based in Los Angeles and brings together a ton of founders. There is Anthony Scaramucci's son, AJ Scaramucci, and his co-founder of Pandos have kind of created a company together and have invited their friends. There's also the Launch House, which I think has gotten a little bit more attention because they're branding themselves as like a future of YC of sorts. They're building out products, live tweeting it, have an open application process, and make TikToks. And I'll pause there. I'm curious what you both think.
One of those is not like the others.
Yeah.
They're building companies, selling customers, and making TikToks. It sounds like a 1980s 2020 investigation into the drug wars. But I think it's amazing. I mean, we can talk about cultural affiliations and whatnot. I think, obviously the internet has democratized building companies more and more around the world. It's still great to get feedback from people nearby. Right. Yeah. So I think we're seeing this all across the United States, around the world. And I do think that they're a little bit temporary. I mean, I've seen hacker houses kind of rise and fall over the last decade quite consistently. They never seem to kind of last. And mostly because they're very community and like community leadership driven. There's someone who's actually building that community around. So you mentioned YC, Paul Graham, Jessica Livingston, and a bunch of others who helped to create that community and hold it together and glue it for a period of time. The same thing's required for every one of these houses. So long as that person is there and doing the work, I think those houses will do well. And, otherwise they sort of fade away and a whole new crop will show up.
I mean, we've seen a lot of this recently reported about, TikTok houses and so forth, and they're having the exact same issues you think they would have. Some successes, some failures, some, who's not getting paid, who's not paying rent, shutoffs and scammers and all that. All that's kind of just the noise and the boom of this sort of collaborative work. I want to be cynical about this and just call them party houses, but the other half of me is like, a lot of really good ideas have come out of some, less serious environments. And so maybe this will pan out. I don't want to be, old man, fuddy-duddy, annoyed with the kids.
To bring the cynical perspective, though, I think a number of people kind of talked to me off the record, kind of for fear of retaliation as one example, that they're not a fan. A couple of investors I talked to said that they would honestly urge their founders to leave a hacker house if they invested in them. While some investors are investing in these houses as a concept, doing product placement and holding pitch competitions. There is definitely something to be said about the kinds of people in the houses. They do lack diversity, most skew male. And I think that if there was a house that got a mix of people right, and a diverse mix of people is what I mean by that, then I'm much more optimistic on them. But right now, I don't think that they're building for every kind of amazing founder out there. I think they're building for a very specific kind of founder who can afford to live stream their lives.
Well, so to wrap up these hacker houses, I used to say that they're petri dishes, but I used to mean petri dishes for innovation. And now the petri dish has a little bit of a new mentality. So let's move on to a more traditional accelerator if you don't want to be in a petri dish. So Ready Set Raise, I guess, has a new class coming out. So Natasha, you talked to them. Let us know what's going on over there.
Yeah, so Female Founders Alliance is a Seattle-based network for female founders and people who identify as female. They've kind of been running an accelerator for the past few years, and they just announced their third class. And I think the most interesting part of this accelerator was that, I was talking to the creator of it, Leslie Feinzeg, and she said that, before the pandemic, we had realized that the accelerator was in some way working, but we also needed to see what we could change about it. And what we could change about it was no longer creating our programming around the idea of a demo day. Most obviously because there's no physical opportunity for demo days, but also because it's not the realistic way in which female founders raise money. It does reward a certain type of personality, demo days. And so Ready, Set, Raise, this new accelerator, is trying to kind of take a step back. They're still going to have one, but they're not going to create all their programming around getting a 5-minute tight pitch where you make a room full of investors and journalists laugh and tweet about you, which I think is an important conversation to have.
And it's equity free. What does that mean in this context? Is there no capital involved?
Yeah, so no capital involved, and they don't take a stake in the company. It's 8 weeks long. They usually had remote programming as 2/3 of the programming anyways, so it was a very easy adaptation. And then the other kind of note about this class that I think is also thoughtful was, usually Ready, Set, Raise would offer childcare for free for the participants. Now it's just welcoming the kids onto the Zoom calls and, very much making that part of their culture, which I think is a great thing.
In the last Y Combinator class, I think we all kind of noticed that it seemed a little bit less diverse. And so I'm always kind of excited by things that are going to help me to kind of push back against that trend. This looks really cool. The Envision Accelerator we talked about a couple of months ago, kind of a similar idea. Natasha, can these programs actually change the numbers, or are these just things that are going to help a little bit?
Alex, I think that you wrote a piece recently about how, women who were going to start a company at one point no longer will because of the pandemic. And I think when I see these kind of focused accelerators that don't take equity, so they give you kind of a comfort and accessible way to think about starting a company. When I see that, I think that could change minds in a way that isn't as flashy as YC or, very important aspect of investing in them. But I think it can bring like that important energy back to a group of people that isn't getting invested in enough.
All right, well, guys, we have gone a little bit long. We're going to cut our fun section at the end about AOC and Twitch because Danny spurled that for us. But as always, a treat to see you both. We're back Monday morning with more equity. We'll see you then.